Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, July 12th, 2017. I wanted to take a look at the markets and just talk on a few different trends. I put up a 60-minute chart today, an updated 60-minute showing my revised scenario, my yesterday's alternative scenario, which is now in play. And in reply to that, member Stock 51 had mentioned in a reply that the MACDs are all pointing up. And that's a good point. You know, there's a lot of different trend indicators you can use. Right now I have a PPO up on this 60-minute chart, but let me show you what the MACD looks like. The MACD, as I often say, is a very close cousin to the PPO. There's the MACD up top. There's that divergence I pointed out last week, and that divergence has played out, and you can see that these lines look almost identical. You can really use one in lieu of the other in almost any instance. However, there's a few instances where you'll see a PPO will actually do a little better at bringing out, showing the divergences. Certain securities, especially high-flying stocks that have had big price advances. So you'll notice sometimes on my 60-minute or daily, I'll have either one. But I just want to point out, and you can look it up. Do a quick Google search on price percent oscillator, and it'll tell you really how it's used. All right, so let's get rid of the MACD. There's the PPO. Prices, the lines are pointing up, which indicates the trend's bullish, but we know that. That's been the trend since last week. There it is. Lines pointing up because prices have moved up. So that the 60-minute divergences have started to play out for an advance. Let me show you a few things I'm looking at here. And we'll get into the trend indicators here in a second. Before we do that, note that the trend, although the very near-term trend since last Thursday, so for less than a week now, prices have been rising. So that's what I'd refer to as the very near-term trend. Swing traders are usually more concerned with, weekly, monthly trend, things that have been going on for weeks or months. And if you look back here on June 9th when the Qs peaked, had that very bearish day, this is a 60-minute chart on the daily chart. That was a big bearish engulfing candle. And you can see the trend has been moving lower. And interesting to note, if I add a downtrend line off that June 9th high right there, here it is, and come into the June 26th reaction high. That's so far where we stalled today. So what I'm looking for now is a reaction here. A reaction being a pause and or a consolidation, ideally a pullback. If that happens, then it helps to validate this trend line. I often say that it takes that third reaction to validate a trend line, at least in my opinion, because any 2 points can be connected at random. So 3 touches gives me a trend line, 3 distinct touches, such as we have here. So a pullback now would really add some significance to that trend line. Now, if you're bullish, it could just mean that maybe prices come back in, backfill today's gap, and then punch up through it. And if we punch up through it, especially a 60-minute or daily close, that's bullish. So there's one thing I'm watching. And just above that, even if we pop above it, I would be cautious of jumping in long because that 141, I think, is a pretty key resistance level. That's where I had my yesterday's alternative, now primary scenario going. We're close enough now. I mean, if we turn down here, that'd be close enough. But either way, I could see that. And if we do take that out, then that's going to be pretty bullish. And really just, I won't say put the final nail in the coffin for the bearish case. That doesn't happen until we take out the previous highs, but it will certainly hurt. And then we have to take out that June 26 high as well. There's a key reaction high right there. That was the first big counter trend bounce after that initial move down. So as of now, again, if you look at this downtrend line, you have a downtrend line here. I'll highlight that. Let me just, I'm sorry, I have so many different annotations and colors on this chart. We'll make them purple so they stand out. And you have the downtrend line here. This one shows you the series of lower lows right here. And maybe that continues on. And this shows you a series of lower highs, and that is what defines a downtrend line. Just like you had an uptrend right here, a series of higher highs and higher lows. So let's see what happens here. The bearish case has certainly been injured, let's say, in the last few days, but not completely taken out yet. Now let's look at the SPY real quick. Show you a similar downtrend. I had 2 downtrend lines drawn on the SPY. This white one, which was taken out today with a gap above. Now, if you notice here, I had one little reaction that was excluded there, one little pop above it. So that trend line doesn't have as much validity as this one up here, this yellow one. So let me move this one away for a second. So this yellow one, we have 1, 2, 3, 4, now 5 reactions. I call this a reaction because, yeah, we've had a few intraday spikes, but so far the SPY has failed to print a solid 60-minute close above there. So again, same thing with the Qs. We have both QQQ and SPY, excuse me, SPY. Qs and the SPY at downtrend line resistance. And again, you know, just trying to visualize it here. I'll draw it out with this arrow tool. You can see the downtrend. It's not a very steep downtrend, but it is a downtrend, and that's pretty much what we're looking at. All right, let's look at a couple trend indicators, and we'll wrap this up. As most of you know, my primary focus in the last few months at least has been on QQQ. Even though it's the least diversified of all the major indices, it's chock full of the market leaders, the FANG stocks. I call them FAME, FAAMG. Those 5 stocks have carried, and they also have a very significant weighting on the S&P 500. We're seeing an unusual disconnect too in the performance of the markets. The correlation, usually there's a very tight correlation between all the major, especially the large cap indices. That is NASDAQ 100, it's all large cap stocks, S&P 500, 500 largest companies in the U.S., and the Dow Industrials, 30 all large cap blue chip companies. Just read an article in the Journal the other day, earlier this week, that stated the correlation between the NASDAQ 100 and the S&P 500 is dropped to the lowest level since 2003, and the correlation between the NASDAQ 100 and the Dow Industrials has dropped to the lowest correlation since 2001. Pretty impressive stats, meaning, we've seen underperformance in the Qs. SPY has held up relatively well, but as I just showed you, the SPY is also in a downtrend. Just going back to the what was that, June 9th, I think it was. So either way, again, you can see the primary trend is up. Now, here's some of the trend indicators that I look at. I've shared this one before. I have a PPO up. There's a MACD. Let me just get the MACD. Let me get the MACD out of here before we do this. Just kind of clean this chart up. All right. So one of the trend indicators, if you followed the site for a while, you've heard me talk about it quite a bit. It's very simple but effective. I look at the 9 EMA, the signal line on the PPO, and it works similar again on the MACD, and that's the white line. I use that because it's the last of the two to cross. You're going to see the blue line cross first, the PPO line or your MACD line. In doing that, it tends to filter out the whipsaw signals because sometimes you'll have a cross of the blue line. So it's just a way to help assure, or minimize, I should say, whipsaw signals. So there's a bullish cross when the 9 EMA crossed above, and the trend was bullish for a while. But before that, you can see here, this doesn't populate a little bit immediately on the left of the chart, but the PPO was well below there, and that was one of the worst corrections that the market had in years. There was a big flash crash back in 2015. Fast forward, go a little forward here, and again, you can see here's our crossover. Right, white line made the cross, and it caught that and told us we were in a correction, and it told us the trend was bearish until we crossed back above there. Then it said, get back in, the trend is bullish. So now you can see here, there's actually 2 corrections right here within one larger correction. I have the divergent high labeled right here, and then the word correction, because that's where prices peaked. That high never took out that previous high, so really the correction ended there, but there was a decent counter trend bounce in between. Point being that you can call this a whipsaw signal or not. You can, 2 different distinct levels where that white line crossed below the 0 line, and both captured the bulk of those corrections, those trends. Here's another correction. I think that one overall was about 9%, if I'm not mistaken. This one about 6%. And again, you can see the line below 0. So here's my point, and this is what I had responded in the to that question or the comment on the QQQ post today. We only have a handful of times where the PPO on QQQ has traded below 0, the 0 line. Every one of those being during a healthy pullback. Wasn't a correction of 10% or more in every case, but they were at least 5% or more, and there it is. So that trend indicator is still bearish for now. We can zoom in, see it's still well below 0, and that's one. SPY, the S&P 500, we could look at the SPX or SPY. They're going to look very similar. As of now, the trend is still bullish, but it's pointing lower. You can see the PPO heading down. And again, it's done a pretty good job of telling you when the trend was bearish and getting in pretty early. I always say trend indicators are not buy and sell signals. I like to wait for confirming evidence such as a break of support or a trend line or a bearish or bullish chart pattern, depending if you're going long or short. But there it is. You can see it traded below zero. Caught and pretty much in all of these cases, this was a quick drop, and we only went below the zero line for a little bit. It's managed to stay above there. You can see a little whipsaw, almost a whipsaw, because the PPO itself dropped below zero, but the white line, the 90 MA, bounced above the zero line. So that's what I'm looking at. Just watch it here. It's heading lower. And the fact that we had this divergent high recently, it was a pretty powerful divergent high, and this is what I've been talking about. This leads me to believe that this crossover, the divergent high, everything else, we have more downside to come. But we'll have to watch. We don't have that trend indicator flipping bearish yet. And let me share just a few more with you. Okay, this is what I call my quad trend layout. I have a lot of trends here. They're labeled up here. Monthly trend, meaning a monthly chart, long-term, spans decades, weekly. All the long-term trends are up. I even have a daily intermediate trend and then daily short-term trend with a few different indicators. So all we're going to focus on right here is this daily short-term trend. As of now, that daily intermediate term trend, which is good for swing trades lasting usually months. But this one here, it captures trends over periods usually measured in weeks. So let's maximize that window and take a look at it. Number one, I look at the 20-day exponential moving average. And if it's simply if it's pointing up, the trend is bullish. And if it's pointing down, which it is now, the trend is bearish. It could turn up here soon. It looks like it's flattening out, but as of now, it's still down. It's, again, a simple, yet what I believe a fairly effective trend indicator. So as of now, like I said, we're pointing lower. And then I have these are EMA pairs. I created custom histograms, so I don't have this chart too busy. Imagine if I had a 39 and a 13 EMA up on the chart here, as well as a 26 EMA and a 13 EMA. And so the lower number is your faster EMA. It's going to respond faster to prices. So what I've done is replicated this or made it into a histogram form. And these crossovers, when it flips from green to red, it just tells me if the 13 is trading above when it's green or below the 39 EMA. And in this case, if the 13 EMA is above the 26, the histogram will be green. And when it's red, it'll be the 13 will be below the 26. So when we cross the zero line, that's where the two moving averages cross. All right, so you can see this has also done a pretty good job of capturing the trends. Just look at, the green areas. If you highlight it here, you go above, and there's your bullish trend. Crossed red, you can see a bearish trend. And you can go, replicate this, do this on your own, play around with these pairs, and like anything else. And the reason I'm doing this video, I use multiple trend indicators because some do produce whipsaw signals. And that might not have been a whipsaw signal. There was a very swift drop, but the problem is we recovered quickly. So if you're going and waiting, by the time if you went short just based on this signal, and then you got out just based on this signal, you probably got out about where you got in from your short, I'm saying. And point being, here's a area, a period of time going back to 2016 where this trend indicator said the trend is bullish, and not even once did it come close. We had a little tiny whipsaw there, but again, I use this one. It doesn't look like it gave us there. That's why I like to see it on both of them. So fast forward to today, I also have these trend indicators. As of now, still bearish despite today's rally, although we're pushing up there. If we continue up past that 141 resistance level I look at, that would that could flip these back to bullish, and this would have proved to have been a fleeting, a fleeting sell signal, if you will. Careful with my words. It's again, trend indicators are not exactly buy and sell standalone buy and sell signals, but they're just an indication of when the trend might change. And I also look, I've put up the SPY here. I also look at the differential. That's why I like to put these EMA pairs in a histogram form, because you get these mounds and you can see when the pairs are coming down to zero. And so right here, for example, you could almost anticipate a cross. You could have seen it here. Here's a good example where you could see the pairs were pinching, they were losing momentum, market was losing momentum, and then you had your crossover right there. So you could have almost anticipated that crossover. And most importantly, again, we'd have to look at a candlestick chart, go back to that point in time. But if that bearish crossover, or these trend indicators flipping to bearish from bullish, if that coincided with a breakdown of, let's say, a rising wedge pattern, head and shoulders, or maybe just a sideways trading range, that would help to confirm that sell signal and also tell you, hey, this is a trend indicator that typically it can capture trends lasting, for several months or more, at least a few weeks. So that's what I'm looking at, and as going through this video, you can see the SPY is very close but is not yet confirmed. So the SPY remains the trend, at least by these trend indicators, remains bullish at this time, but it's very close to crossing over. So I think the markets are a pretty interesting potential inflection point. So right now, probably just best to wait and see what happens, wait and see if the Qs can power up and take out those resistance levels overhead, flip these trend indicators back to bullish, or if the market suddenly turns down in the coming days and the Qs remain on those sell signals, those trend indicators remain bearish, then the SPY also goes bearish, and then we want to start looking at the longer term trend indicators, those ones I went over earlier. Let's wrap it up here. So again, most important thing right now, I think, even more so than these trend indicators, would be those downtrend lines that I covered in the beginning of the video on the 60-minute time frames, because we have both the SPY as well as QQQ challenging those downtrend lines. So let's see how we close the day and how we follow through tomorrow. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.